The Financial Huddle does not provide tax, legal, financial, or other professional advice. Listeners are encouraged to consult with their own advisors in these areas.
All right, everybody, huddle up. Play calls in. This is the Financial Huddle. Ready? Break.
Welcome back, huddlers. It's time for our next episode of the Financial Huddle podcast.
Oh, yes, sir.
As usual, I am joined by my partners in crime, Ryan Fleming.
Absolute pleasure to be with you, boys.
And Mr. Brian Manier.
What's up?
What's up, everybody? What's up, huddlers?
Hey, it's great to be back. Great to be talking about a topic we started talking about last podcast.
Yes, we did.
Continuation.
So we are going to kind of pick up where we left off a little bit and get a little more into what I like to say, get into the weeds, get into the details.
The weeds.
And our topic here is 5 reasons why a Roth 401k could be considered over a pre-tax 401k.
Yep.
And as Ryan mentioned in our last episode, probably one of the most popular retirement plans or strategies out there is the 401k. Mm-hmm. You know, most people graduate from college, go to work for a company. Mm-hmm. The company offers some type of pre-tax benefit to their employees. Traditionally, 401k, if you work for the government, other entities, could be a 403b. And we just start putting money into it. Don't know, why. We were just told to do it, and we just start investing money.
The person in the cube said next to you.
Yeah, hey, just do this. Okay.
Hopefully they're getting a match.
And maybe. I can't touch it for forever. Yeah, that's right. So, but, another thing that was mentioned in our last podcast was talking about the power and implications of taxes.
Yeah.
And it's not just taxes when you're 65 and ready to retire. It's really, you need to look at taxation and how it impacts your investments, your options, what you're looking at throughout your lifetime. So the concept of the whole Roth 401k, similar to a Roth IRA, you're just making after-tax contributions to have tax-free growth in the future. Mm-hmm. And that is a positive, right? Yeah, everyone wants tax-free assets, tax-free growth. But, once again, if we go back, doing a little historical significance, the Roth was signed into law in 1997. It's not been that long ago. I mean, this is something relatively, as far as financial vehicles are concerned, that's relatively new.
Yeah.
So we're going to go back to, it's that time again here. We're going to kind of kick off and dig in, but it's that time. It's that time.
It's that time.
So Ryan, why don't you
gotta love the
shed
stats.
a little sunlight on what we're talking about?
Gotta love the stats. Hope you huddlers love our stat time, and
we like it.
You're coming out with a couple more that we love it. Hopefully, you guys love it. So. A couple other things to know, this idea of a 401k. We recognize it's not the only vehicle people can save retirement dollars into. I mean, there's things like traditional IRAs, SEP IRAs, deferred comp, 403bs, TSPs, like tax shield. Yep. Yeah, so, but this is by and large a biggie, okay? And but also of note that I think is important is that these 401ks were a byproduct of pensions kind of going away through the ERISA Act, right? So the Employee Retirement Income Securities Act that kind of like fizzled a little bit, and that's why we don't see tons and tons of pension programs nowadays. And
well, you could also argue corporate greed.
It was too expensive.
Why'd they get away with pensions? Because it costs a lot.
There you go.
A little expensive.
There's always a why behind it, right? Yeah. But the 401k, by and large, really got launched like in 1980, right around there, 79, 80, right around there. But this idea of Roth, like Ed talked about, I think this is important to understand. Darn near 100% of employers offer an after-tax Roth contribution opportunity. 95.6% of employers offer this Roth 401k. And
that wasn't around when I graduated. Obviously, I'm a little older.
Yeah,
a little seasoned.
There was no such thing as, it was a traditional 401k. So these are relatively new options.
Exactly. And to put that in context a little bit more, huddlers, since 2015, back then only about 59.9%, so about 60% of employers offered this after-tax Roth contribution opportunity. So that was interesting to me. Another stat is even more interesting to me, and this is why we wanted to do this today, huddlers, to be honest with you. So given the fact that this is the case, that almost 96% of employers do offer this, 21 to 22% of participants use the Roth option, which was actually kind of astonishing to me.
Yeah. There's a lack of awareness, and I'm sure you guys see it when you're talking to people. If you ask the question, does your company provide a Roth option in your 401k? A lot of time, not sure.
They don't know.
They don't know.
And we want to really bring awareness to this big time. You guys have heard us have kind of a repetitive narrative about taxes, the rising tax environment that we're in. So a couple other things as a follow-up to that as well, and not a lot of people know this at all either. 20% of employers allow Roth match contributions. So think about that. So what the company would put into the 401k typically has always been pre-tax. But what this stat is saying is that 20% of employers now allow the matching portion to go into Roth. And of that, a very, very few percentage of people even have that happen. And very, very few percentage of employers even bring it up or even are executing that. So, as a employee, I think what I want to say to the huddlers here is that the reason why we said this could be considered is because a lot of people fall in our country within that 22 to 24% tax bracket. Now, if you're in the 10% or the 12%, you really got to do a little bit more statistical analysis if this makes sense or not. If you're in the 32, 35, or 37% brackets, the Roth contribution might not be what you want to do. You may want to do pre-tax to get that deduction. That's now. Right. But the sweet spot that we're talking about here covers a very wide range of incomes. Just to give the huddlers an idea, the top of the 12% bracket is right around $100,800 for this year. And then moving into the top of the 22% bracket, that gets us up to like $211,000. And then the top of the 24% bracket is over $400,000. So that 22 to 24% bracket covers a humongous,
pretty significant range.
Exactly. And that's where we would say that that's kind of the tax sale of a lifetime.
And this is what's pretty cool about that. If you phase out of doing a typical Roth IRA, you can't make a contribution because your income is too high.
Yeah.
Well, guess what? With the Roth 401k, you don't phase out. You're able to contribute.
Right. So it is a way. Once again, it's specific to each individual. Just because they're at a higher earnings.
Yeah.
That top of the 24,
it could be favorable because they cannot contribute into a regular Roth.
That's right. And as you said, that 24, there's a large range.
Right.
It's huge. It's huge. So with that, we wanted to honor what we said. We want to do the 5 reasons to consider this. Okay. And I'll start off with number 1. And it's this idea that I brought up last time that Brian talked about. It's this idea that we have a huge tax rate risk to our dollars. That it's the idea that taxes are on the sale of a lifetime. If you look at since 1913, when the government started enacting income tax on our income, all the way until right now, 2026, we are at some of the lowest quartiles ever in the history of our country. Huddlers, the highest income tax bracket for the highest earners ever in our country was 94%. The entire decade of the 70s, the highest bracket for the highest income earners was 70% or above. And today we are at 37% for the foreseeable future. I think we've got about 10 more years or so before taxes and the IRS and the government are going to have to go bananas and bring in more revenue. And the justification for that is what you talked about last time with Lawrence Kotlikov, who does that fiscal gap counting, says that the Social Security Trust Fund is going to run out like in 2033, the Medicare Trust Fund at about the same time. And so here we are in 25, 26. We've got 7, 8, 9, 10 years, I think, before things might have to happen in the future. But
and whether we're blue or red could also lead to possible tax changes.
You could, but I honestly think that it's really an apolitical thing because it's a math problem.
Yeah.
And it's unsustainable what we're doing. And so nowhere in Europe does a country have as much debt as what we have and as low as a tax situation that we have, so on and so forth. So the number one reason that we might want to consider contributing to a Roth 401k over a pre-tax 401k is that we have a massive tax rate risk. So when do we jump off the tracks?
That's right.
And divorce ourselves from the government?
And we talked a little bit the last podcast. You're in business with the IRS and the government, right? So
It's not all yours.
do you want to be the managing partner, or do you want to be the minority partner who has no say?
That's right.
And that's what you're doing there. You're controlling that
Good word.
outcome.
That's a good word. Yeah, because every single year that we delay paying the tax, then we could get an amazing rate of return. Plus, we're paying the fees just to put more money back into the government's pocket. All right, so think about that. We take on all the risk, we pay the fees, and we defer the tax at a point in time where they get to vote on how much more of that money they get to keep.
And it's funny.
That's crazy.
I have a number. I have not a lot, but some clients that have very, very left or right viewpoints, and they're always like, "Oh, the government's going to come in and they're going to take all these company-sponsored 401ks, 403bs. They're just going to come in and take it." I said, "Well, they're not going to take it." I said, "What's the easiest way for the government to get more of yours?"
Just raise more revenue, bring in,
Well, raise taxes.
taxes, right?
Yeah. So they're not taking your money, in the black of the night, wearing ski mask and gloves. They're just passing higher tax rates. I mean,
my goodness.
that's what's going on here.
Right. There's a lot of ways that
They might be
government
wearing that as they're
They
doing
could do that
Yeah.
too, but
So number one, tax rate risk. What would be number two?
Well, and you've talked about what we talked about last podcast, where we have all of these obligations to fulfill.
Oh, yeah.
One of those is Social Security.
Yeah.
So a lot of people don't realize your Social Security, believe it or not, for most people is taxed. Those benefits, you're going to pay taxes on the benefits, and that's based on the provisional income. And the
Yeah, it
provisional
can be taxed.
can be
Hopefully
taxed.
it's not
Yeah.
taxed, but
Right. And so the provisional income determines how much of those benefits are going to be taxed. For most people, it's up to 85% of your benefits at ordinary income rate. Here's the thing. There's two things that are not included in that provisional income: cash value life insurance distributions, and you guessed it, Roth IRA. So if you contribute to
Roth
a Roth
401k.
401k,
Yep.
works just like a Roth IRA, that's not included in the provisional income, you have a much better chance of lowering the tax obligation on your Social Security benefit.
absolutely, yeah.
Yep.
So number two would be anything that has the word Roth in front of it. It does not account against the provisional income,
Right.
Which is phenomenal.
That's right.
Right.
Another thing, as far as obligation, we talked about Medicare. The way that your Medicare premiums, Part B premiums, are determined is based on what is called IRMAA brackets.
Mm-hmm.
That is determined by modified adjusted gross income. Guess what's not included in adjusted gross income or modified adjusted gross income? You guessed it, Roth IRAs. So if you contribute to a Roth 401k, that is not going to be included in that, and that will help keep those
The Medicare premiums.
Part B premiums in that lower or one of the lower brackets.
right.
Yep.
Yep.
It's okay. That's awesome.
Yeah, and then when we look at what are the other advantages? The next point number 4. This whole concept of RMDs, required minimum distributions, and it's been the last couple of years. There's been a lot of changes. We go back not too long ago. The RMD age was 70, 70 and a half. Well, now it's if you were born after a certain date, it's 73. If you were before
1960 or after,
Right.
it's 75.
75.
Yeah.
And so with that case, what that means is the government's going to say, hey, keep deferring, but you can only defer it until this point. At some point, we want ours, right?
That's right.
We need to
Pay
get
the piper.
our taxes back. Well, guess what type of account does not require RMDs?
Let me guess, Roth IRAs.
Yes!
Hey.
Roth IRAs, Roth 401ks.
Now, that didn't always used to be the case, right?
No, it didn't. No, it didn't. That's a relatively new, basically legislation was passed on that.
That's a big deal.
It
Yeah.
is, because if you can take advantage of that, if you don't spend those down, that's a lot more money you are able to leave to your kids or whoever your beneficiaries
Right.
are. And you get to leave that in a tax-free manner.
Tax-free manner, which is much better than leaving it in a pre-tax account, which we have kind of touched on before, and the tax implications that I think, Brian, you mentioned in the last episode there. And then the one thing a lot of people don't think about, because most people are worried about themselves in their current lifetime, but for those that go a little more strategic and look at planning, they're thinking of their heirs and the legacy. So
Yeah.
how does that work?
Yeah, I always talk about this in my classes when we talk about legacy. When you think about pre-tax dollars, and you mentioned it, RMDs, they keep extending the ages. It was 70 and a half, and everybody was confused. Well, where's the half? What does that mean? okay, let's do it to 72 and then 73 and now 75. And I'm like, that's kind of interesting that they keep deferring that when we know there's a shortfall of money. We need those taxes. Why do they defer that? Well, guess what happens when you don't spend that money? Your kids get it. What do your kids have to do? We talked about this last episode. There's that 10-year rule.
Right.
That 10-year rule, you have to liquidate the entire account within 10 years. You're going to pay more in taxes because that's in addition to the wages that you're making. If taxes change, like we've talked about.
Oh, yeah. What if they double?
We call it a tax bomb, right?
Tax bomb.
So what happens with Roth IRAs when you inherit those?
Or
you still have to
Roth
spend
401ks.
you still have to spend it in the 10-year period, but you don't have to pay the taxes on it. It doesn't impact Social Security. It doesn't impact IRMAA. So a lot of people, when they think about IRAs or pre-tax versus Roth IRAs or Roth 401ks, one of the things they're not thinking about is what it means from a legacy standpoint.
100%. I mean, it is really, really important to consider that as well, too. So, these 5 things, I think, are top of the line considerations. Again, it's different for every single person, obviously. We would have you come in and talk to us about that. But, yeah, I think you guys hit the nail on the head. I think those are legit.
Yeah, we don't want to say that every person should do a Roth 401k.
Yeah.
But it should be considered.
Could you do partial?
And you can. I mean, you
Hedge
can
your
go
bet.
up.
Kind of hedge your bet.
You can go up for higher income earners. That is a topic of conversation. Is you may be looking for those deductions now,
Right.
But what about in the future?
Yep.
And so you can mix it if you want, but you have to determine what is best for
Yeah.
you. So we're not saying everybody needs to do it, but in light of what you said, Ryan, more and more companies are creating this offer to do.
And within those
Roth
tax brackets,
401ks.
considering those income levels in that tax bracket,
Look at
there's
those
a lot
options.
of people that fall in those brackets.
That's
that
right.
22 to 24.
Right.
Lots.
Yeah. And so, to kind of wrap this up, I mean, just like any option out there, it could be different for each individual. And that's where working with a financial professional like us. Hey,
Like us.
who would have thought
Shameless
that?
plug.
Yeah, shameless plug. Sorry. My bad. But, we talked in the last episode, and we've talked many times before about bucket planning, right? Just having, you have your now bucket, kind of a more midterm, you have a long-term buckets. All these buckets have potentially different, not only asset classes, but they're also potentially treated different from a tax standpoint.
100%.
So,
Yeah.
so having a mix of each of those, and once again, if you're afforded that opportunity within a Roth 401k, what we're saying is you definitely should take a look at it and seriously consider it, and then speak with a financial professional about that.
Yeah.
To really see what fits your specific situation.
Yeah, I agree. It's just you got to follow the evidence.
Yep.
Right. No one knows exactly for sure, but we have to use a rational mind and figure out where does the evidence lead us and what is most plausible.
Yep.
And then put your trust into that.
Yep. So Huddlers, thank you again
Yeah.
for joining us. I hope we shed a little bit of light
Good to see you, Huddlers.
on this. I'm sure you've heard the Roth topic. You most are familiar with 401ks. We just try to dig a little deeper here in these last couple episodes here. So appreciate you listening. Appreciate you watching. If you're watching, or both, you can listen and watch. Anything's possible.
Anything's possible.
Pass
today.
it on to other people too.
Yes.
So hey, pass on, get other people, have them join Huddle Nation. The more the merrier there. So
There's room.
guys. Until next time, once again, thank you. We're signing off.
Take care, everybody.
but
Like
God
and
bless.
subscribe, please.
Yep. Take care.